What's up, everyone? Welcome to another Market Radar podcast. It's been a pretty eventful week. We're finally seeing NASDAQ pulling back, and based on our system, we are seeing growth remain fairly resilient, although not enough conviction to give us that entry that we're looking for. But that could quickly change, especially with this NASDAQ pullback. The system does typically get good entries on pullbacks historically. So who knows, maybe we'll get a risk on pretty soon here, but that's really dependent on growth. But what I can say is, based on our system, growth has been remaining fairly resilient. So we'll see what happens, see how this develops. But we did see quite a lot of movement in bonds this past week. That's kind of been the talk of the town. We saw ZB absolutely plummet. We're seeing 30-year yields rising, 10-year, 20-year. All the long end of the curve yields have been rising. So let's talk about that, and what does that mean? You want to kick us off and get us into what that means, basically?
Yeah, so obviously yields on the long end are lifting. Everyone thinks this is inflation related, right? Everyone's concerned that, okay, man, maybe inflation, we're going to get that round two that everyone's trying to compare to towards, or that we experienced in the 80s, late 70s, early 80s. They're thinking round two is going to come. And a lot of people actually believe that round two has to come. So I
Well,
think a lot of
so is this caused by inflation fears, or is this caused by the credit downgrade that we saw this week?
I think it's a little bit of both, but it's more of, I should say it's both, but it's more weighted on that credit downgrade because what happens is, and what most people don't understand when they see a credit downgrade, why do rates go up? They all think, oh, rates are going to go down. That means the economy is deteriorating, right? That means recession. Well, historically, when we've had credit downgrades, they were a result of not meeting debt repayment obligations, right? Call it default or any type of debt ceiling debacle, or the most recent one in 2011 was in fact that debt ceiling debacle. As the idea that, well, the the government may not be able to raise the debt limit and may not be able to repay its debts, and because of that risk, the rating agencies then therefore downgraded government debt, U.S. government debt. This time, on the other hand, we've basically kicked the debt ceiling limit down the road to the point where we don't have per se that a limit right now, and fiscal borrowing slash spending can become very irresponsible. Obviously, the debt ceiling, some people argue it's nonsense. We just keep raising it. Oh yeah, we have to keep lifting it, right? Everyone's like, oh my god, it's a joke. We always hit it and erase it. Well, unfortunately, for a lot of people, and I guess most people don't want to hear this, but yes, it is a joke. No reason to have it. But fortunately, we do have a point where everyone has to say, well, what are we going to do now? And the fact that we've kind of kicked that can down the road, not obviously unlimited, right? But we've pushed it down the road far enough to where rating agencies now can look at the scenario and say, well, there is more risk of irresponsibility at this point in time. We have to move the needle down a little bit. Now it's not major. We're talking about one step on a chart. We're still talking about high grade debt here. We're not even in investment grade territory, meaning we're not even this is not if you have to think about this, this is an inch down in high grade credit ratings and still not even, we still got a mile plus to go all the way to junk bonds. So it's not like the US government is junk rated now or anything crazy like that. If that was the case, we'd have a lot more drama in markets than just, 10, 15 basis point moves in the long end. It would be
Yeah.
much more dramatic.
Well, so
So
in terms of the inflation component of this move, we did see crude oil hit bullish trend this past week as well.
that was
So
interesting. Yeah.
is that something that's like sparking fears in bonds, and that's why we're seeing bond yields rising? Is
I,
that is
I
that a
think
contributor?
I think it does have, so like I said earlier, the credit default risk or credit default fears, I shouldn't say credit default, excuse me, the credit downgrade risk, which was rapidly priced in because that credit downgrade wasn't like a binary event, right? It wasn't like, oh, Fitch is going to have a meeting today. They may or may not downgrade debt. It kind of, well, obviously they have their internal meetings, but it came out of the blue towards the markets, to the markets. The markets didn't expect that. The markets didn't even anticipate a possibility of that. That just was one day, boom, right?
Yeah.
And when something like that happens, you shock the most sensitive areas of which that news affects, being interest rates. And we can take a look here. We'll look at the long end right now. Start, and right here you can see off that news immediately, rates move higher. I should say they rapidly move higher, right?
Well,
And
so is this just noise? And over
yeah,
time, over the
it's
next
not.
few weeks, we'll see things normalize a bit.
I mean, we already saw some normalization on Friday, right? And
Yeah.
again, you're going to have the macro monkeys. That's my new word for these. Macro tourists are one thing. They don't know. Macro monkeys are just idiots, right? So
Yeah.
macro tourists are guys that are on Twitter. They started in the day trading space and they fall into the macro category and they're like, oh, this is interesting. They start introducing themselves via Twitter, or should I say X, to more and more intriguing content.
But
And they're macro
they're
tourists.
very
They're not.
linear
Yeah,
thinkers.
yeah. And then you have the macro monkeys that are basically like they're the real linear macro guys that you and I both know who they are. They're always saying this has to happen. They're cheering for recessions, all this type of nonsense. They're the macro monkeys. Now, they've come out and they said that rates have peaked. Okay. Because apparently the macro crew, you got two people right now, and there's a lot more people that are looking for a recession than aren't. And the people that are looking for a recession, they believe that bonds need to go up from here. Bonds are going to go up from here. Rates are done. Inflation is going to crash, straight line down to zero, the whole nine. And then you have the other side, which is basically saying that the Fed is going to hike to oblivion. There's this theory out there that because the Federal Reserve isn't really concerned with inflation, they're more concerned with this global supply, keeping the global economies in check in terms of having the last word, right, in monetary policy. Because believe it or not, the Fed does in some way set the standard for lending worldwide, right? Because treasuries are seen as one of the world's safest securities. We're talking about paper securities. Obviously, you can go to gold or whatever, right? In terms of like no default risk. But next to that are the U.S. treasuries. They're seen as the safest. So when the United States starts raising interest rates, everyone takes a look and says, okay, something's going on here. And because of that, some people believe that the United States is basically trying to start this monetary war with other countries based on interest rate policies and whatnot, and just basically hiking until something breaks basically foreignly, not domestically, right? I don't think that you can take either approach because you're going to end up in a situation where I want to say, too skewed in one direction, right? The most powerful thing in markets is understanding that the worst and best things are never going to happen. And if they do, they're black swan events. So basically, preparing for one is not the same as understanding its possibility, because when you prepare for it, you're allocating your resources towards that scenario, and likely it is not going to happen. Now, the chances those black swans do occur, it's typically not the end. I mean, obviously, it's not the end of the world. Otherwise, we wouldn't be here today because we've already had a bunch of them. And pretty much the market itself recovers. Just because interest rates are moving up, government's downgrading debt, it doesn't mean the United States is now a worse country. It doesn't mean that the government is going to default. It doesn't. None of this means much right now. But we were talking about one-step downgrading. U.S. government debt is still considered high grade. So in terms of quality, it's still very, very. It still holds an extreme premium again over a lot of other countries out there.
Yeah. Well, I want to take it back to the inflation question. So a lot of people are afraid of another 70s type situation with the second wave
Okay.
of inflation. We're now past the phase where base effects of CPI are bringing CPI lower. We're reaching the tail end of that. We're now
Yes.
seeing crude oil starting to break out, switching into bullish trend. DBC is the commodity index is at Momo right now, so even
Yep.
that's nearing bullish trend. We're seeing the 5-year break even rate failing to break lower, and it's actually risen a decent amount over the last couple of months.
Yes, it has.
So
So
there
go ahead.
there are fears for another inflation wave coming, and is that something that people should start preparing for, or how do you prepare for that even?
Okay, that's a good angle, and I think the first step is we have to isolate if that wave is coming, right? And let's look at DBC as is the broader view of everything that we can take a bird's eye view right now. DBC isn't bullish trend yet, but yes, you're right. We've come up great. We've come up quite a bit in the last 2 months. Now we're at Momo. Things can get interesting rather quickly. So the first thing we have to understand is what's going to constitute an inflation flip in terms of prices going higher. Obviously, the first thing is going to be commodities flipping trend. Crude, as you said, as I showed, and as you said, has already flipped trend. It's now bullish. So that's something that, well, okay, something's changing. Something has changed. Now, the second thing that we'd have to really be the confirming factor here would be the entire commodities index to flip bullish trend, which really would assert that yes, something material within commodities has in fact shifted. The problem with just the trend shifting, that's a baseline, right? When this entire last year or 12 months, prior 12 months, I've been claiming that inflation is not a concern, so commodities are bullish trend. And what I'm saying is, well, if they're bearish trend, they're most likely going to be the bearish trends are most likely going to lead to lower prices. So it shouldn't be that much of a concern for the for inflation, and the inflationists really have nothing to chant about. Well, once this goes bullish trend, you now have this possibility. When I say possibility, I don't mean guarantee that inflation can accelerate. Now, again, you might be thinking, well, commodities bullish trend can go higher. Bullish trends tend to lead to higher prices. Well, higher prices are bad for inflation. Yes, they are, but it matters not so much at where the prices go, but at the speed, but rather the speed at which they get there. So if we go bullish trend and we start breaking out higher here on commodities, do we go to 27 or 2750 in a year and a half? Or do we go to 2750 in 2 months? Because that'll play a huge, there's a huge dynamic there in terms of inflationary effects. If we're slowly grinding higher, yeah, base effects will eventually hurt. Next July 2024, if this is up here, the CPI print would look pretty bad, right? Because we're taking basically commodity lows versus commodity highs.
Right, but
If
it's
commodities are at
mostly
highs,
the volatility that
right?
matters.
It's the speed because let's just say it takes a year to get to 27. Well, a lot of this whole thing would be understood by then, right? As commodities go up, these base effects are very easy to price in with when there's low volatility in commodities and other assets, right? Because if you know that even in a steady trend, right? Like this is what killed everyone. This type of move here in inflation or in commodities, which contributed to inflation, even from 2020 after COVID. Like this whole move was just violently upwards. If you have these moves that go like this, very slow, up and down, slow, up and down, right? Like we're talking, obviously in 14, this initially shocked everyone, and everyone understood what was going on. The oil crisis, oil was getting dramatically cheaper, but outside of these windows of dramatic price movements, commodities move rather consistent in terms of like trends that are lasting in either direction. So because of that, you can almost bake in base effects knowing what's going to happen, right? Like for example, everyone knew the reason inflation expectations were, or I should say CPI expectations were down so much month over month. It just showed it as basically falling like a rock down to 3%, was because everyone understood, and we were talking about this too at the beginning of the year, that base effects were going to weigh on inflationary numbers because you're comparing this period of, let's just take March, right? March of 23, prices of March 2023, the prices of March 2022. Like it's almost, you're comparing a period of prices that was higher prior in time compared to where we are in lower in real time. So you have this disparity between these two prices that it's very easy to see. And when commodities are moving rather very controlled with low volatility, it's easier to extrapolate that trend. So by watching this go bullish trend, obviously would be the first sign that, man, okay, commodities could start accelerating higher. That's an issue. Regardless, I mean, we don't. Even though I say that the speed matters, it's somewhat of an issue. We don't want to see commodities going up right now. I
Yeah.
mean, we have
there's other
crude.
things to monitor too. So we would monitor 5-year break evens as well. And what else is something that people can monitor?
So they can monitor 5-year break evens. They can monitor the price of crude, and they can monitor
What about real yields?
Commodities. Real yields are though. That's very interesting. I wouldn't monitor real yields in terms of inflation because real yields have this restrictive component to them, excuse me, where the Federal Reserve can basically control real yields to a degree outside of inflation, right? Um, if inflation starts accelerating drastically, you would see real yields come in, right? Where we have real yields here. You would if inflation starts accelerating drastically, you would start to see real yields get basically flatten, right? As inflation starts accelerating again, right? Break even rates throughout the curve would start to lift. And what would happen is you would compress this real yield. You would basically bring this down to zero. And that's not so restrictive. Basically, you're normalizing the nominal rate, making it not out of normal, which is what's needed right now which is why rates are so high to generate this positive real yield. Which positive real yields are restrictive on the economy. Negative real yields are an easing proponent in the economy. So we want restricting components, and for them to have for us to have a restricting component, we need a positive real yield. So if the Federal Reserve raises interest rates, what's going to happen? Oh, or I should say, if inflation starts to accelerate, the Fed is going to then have to raise interest rates further, which I don't think that they are going to have to do that. At least at the
I think it would depend on the volatility of the inflation. As you said, if crude oil skyrockets from here, DBC skyrockets from here, they might have to raise in that case. But otherwise, they would just hold rates and let the duration of the elevated rates weigh on inflation. And so any minor spikes or choppiness would just get further pushed downwards just by holding rates. They might not even need to raise rates, but yeah, as you said, if volatility of inflation is high and we get another move like we did in 2022 where crude oil just skyrockets, commodities skyrocket, that's when their hands will be tied and they'll be forced to raise rates even further.
Right. Yeah.
But hopefully that doesn't happen. I'm really sick of inflation. I'm sure everyone is.
I'm sure everyone is. Yeah. And
it would be nice to just get out of this mess already. But let's take a look at the tens and twos. So tens and twos, we've made quite a few videos talking about these, Great Recession leading indicator, and we saw a move up to Momo. So this is almost bullish trend, but the move didn't happen normally. I don't know how to put it, but this move happened because the long end rose, which isn't typically how we get reversions. So how do we interpret this move?
Right. So the 2s and 10s, similar to break evens when you measure the spreads, if one of the components moves disproportional to the other, right? What ends up happening is you have a dramatic change in the spread value. So if the 2-year moves way more than the 10-year, up or down, you have a drastic shift in the spread, and that's what the spread is basically telling you. So the reason why the spread has fallen so much is because the 2-year has moved so much from being non-inverted, basically lower than the 10-year, to well above the 10-year. And the reason the 2-year moves so much is the Fed controls the short-term interest rates. They have more control over the short-term interest rates because they control the federal funds rate. Whereas the longer-term rates, obviously, you have more risk of the cycle, growth and inflation components, which would therefore affect longer term rates much more than the Fed's current policy rates, and supply and demand is pretty much more on that outer side of the longer end of the treasury curve. So now why do these rates move differently? And again, Fed has more control over the front end, long end is more supply and demand. Also, the long end is less volatile because there is a proven belief, I'm not going to say common, it's proven, that the Fed can control inflation in terms of bringing it down. Okay, we have not. The Fed is good at getting inflation back under control because they will just do whatever it takes for as long as it takes until there's a recession, which will bring inflation back under control. So the Fed at the end will get inflation under control. Recession or soft landing, however you want to put it, they'll get inflation down. So the longer term interest rates, they tend to not deviate so far from the Fed's targets because they understand that over the long term, the Fed will most likely meet their objectives.
Right. Well, so the thing that's different about this move that we're seeing now is the long end yields are rising, whereas the short term yields are staying the same. Whereas typically a reversion, which predicts recessions most of the time, happens the other way around, where the front end of the curve drops, whereas the back end does not.
Right. So let's clarify why this spread is negative, right? So if we take a look at interest rates right now, the 2-year is at 4.77, the 10-year is at 4.04, meaning the 2-year is above the 10-year, which in terms of lending money and basic banking, a longer lending your money out for longer duration demands a higher interest rate, right? So that's a normal yield curve. The longer you go out in time, the more interest rate the higher of an interest rate you should receive. That's the opposite right now. What's going on is the Fed has raised interest rates so far on the front end that longer term inflation expectations are so low that even with them rising, accounting for the fact that the Fed has now lifted policy rates, and no one knows if the Fed's going to go back down to zero, right? So the market's not going to anticipate 100% certainty that after the next year and a half, 2 years, once the recession cycle is pretty much guaranteed to go through, that the Fed's going to be back at zero. No one really knows. So long end is lifting, but nowhere near as much as the front end. Obviously, supply and demand, long end versus Fed on the front end, like I explained earlier.
But does this partial reversion have the same amount of weight as a typical reversion?
No, because what's happening is on the long end, you also have to now price in the credit downgrade, right? So the credit downgrade is going to automatically lift long end rates. Okay. The Fed again controls the front end. So the front end, the 2-year, is going to be less influenced by that credit downgrade compared to just an extra basically 5 times that out into the 10-year, right? So like the 10-year is going to have more of an effect on time than there is in the 2-year because if the Fed wants to hold for the next year, right? Powell's saying cuts in 2025, right? Was it 2025? Yeah. That right there is implying that the Fed can hold rates at the current levels for a while. The Fed's going to have more influence over the short end of the yield curve compared to the long end of the yield curve. So it's a credit downgrade of this magnitude. We're not talking substantial. Obviously, junk bonds would if the U.S. got graded to junk, it would more likely affect shorter term maturities, even 2, 3, 4, 5, etc. But this type of credit downgrade is minimal, and we saw a little bump on the long end, but it's not it's not sufficient enough to really change the front end in terms of like pricing above where the Fed, basically implying the Fed's going to have to lift rates further. Because otherwise it wouldn't be restrictive enough. Long story short, this is not the same type of reversion. In a real reversion, picture the two: the Fed on the front end and the market basically on the back end on the 10-year. The Fed would cut rates dramatically, and again, the back end supply and demand. The reason the Fed's cutting rates dramatically is we're in a recession, right? And the market knows long term inflation is expected to average around that 2% mark, which is why when you go look at, let's look at long term inflation expectations, right, on 30-year, there's a reason why these things trade outside of COVID up near 1.92%. Like if I were to draw a line here at 2% right here, there's a reason why they trade close to this. They don't go way, way up, way, way down. I mean, in terms of scale, like let's just bring this down. This is a rather tight range. The reason for this is because the market understands that the Fed will control inflation over the long run. So when we see bond rates like the 30-year up so much, we have to and obviously the 2% goal is in the last 20 years. This is not something that went back all the way in the early 90s and so on and so forth, which is when interest rates were much higher and the Fed didn't have this objective. They weren't so precise about making it known to everyone that they want 2%. So interest rates were more volatile. Obviously, we've seen volatility come down a lot despite the recent fall in COVID and rise thereafter. And rates have been rather tight. So long story short, when you have a real yield curve reversion, this occurs when the Fed has to cut rates on the front end drastically. The back end doesn't move down as much, and therefore you get that positive yield curve spread again, which would look like this line these candles going through this black line. So right. until that happens, in terms of the Fed cutting rates, I don't think we're going to get a yield curve reversion until an actual recession does come. But
even if inflation fears do persist, it's going to be followed by further hikes. If it really is an issue, it's going to be followed by further hikes, which would stop this from reversion.
Yeah,
right?
Exactly.
So what we're seeing now in these 10s and 2s is more so noise that was caused by the downgrade.
Yeah. Now, obviously, just look at the last 3 days, right? 3 days ago, last trading week. Last week, we were sitting at negative 90 basis points. Now we're at negative 70. So we've moved almost 25 basis points in 1 week. Now, obviously, we can't ignore this, though. We have to pay attention. If this goes bullish trend, that's an early indication of higher possible prices or higher possible yields in terms of the spreads here. Not overall yields, but in terms of the 2s and 10s yield, which is negative 73 basis points right now. We saw this bullish trend briefly happen in early March or late March after the SVB crisis, but that didn't materialize, and we flipped back to neutral trend, then bearish, and then we sold off pretty hard. Long story short, though, this flip to bullish trend was something to watch. It could have led to higher prices, but once we got this was the on recession watch, basically. Like, oh, we might be getting a recession. The recession is basically one step closer when this goes to bullish trend, because that basically means that rates can grind higher, go towards zero, and revert and give us that real recession indicator, with the front end likely being cut in the process. So remember, we're negative 70 basis points. We're not going to just wake up one morning and be plus 10 basis points and be like, oh, yep, recession's here. It's going to be a buildup, as it is always in terms of how this spread works. And we can go back in time. Like, look here. Like we go down like this and we go bullish trend here well before we revert. And this is the sign. Okay, something's going on in March of 2007. Something's going on. Everyone wants to say, oh, the yield curve reversion predicts a recession. Yeah, well, before the yield curve can revert, if we're inverted, we have to go bullish trend first. So that's the step one. That's stage one.
Yeah.
Then we
gives
get to
us
zero.
A little front run before the main crowd gets in.
Exactly. And now we're in such a situation where we're in a specific situation where we're so deeply inverted, right? Where these types of bullish trend rips can be fake outs, which we just saw. So just because it goes bullish trend doesn't mean like it's time to pile in for the recession. It's guaranteed. It's Nothing is guaranteed. Pay attention, follow the cycle. The market will guide. Aries will guide, and the system will guide. Don't
Everything
run.
seems to always line up too. So we've been doing this for quite a while now, before market radar was even a thing, and things just line up. So once the actual deflation trade recession comes, which it always does, it's inevitable, it's going to happen, and this 10 and 2 spread starts setting up, we get bullish trend and everything, we're also going to see other things, other key criteria in the system also line up with that deflationary trade. So it's not going to just be this one indicator that's telling us something. We look at the big picture of everything, and there is going to be other things signaling deflation as well. We're going to see ZB possibly above Momo, bullish trend at the same time as this goes bullish trend, something like that. There's going to be other metrics that happen at the same time. It's never just one thing that catches everything. There's no such
Yeah.
thing as that. So
And you're not going to
yeah,
wake up one morning either and be in like a full blown recession out of the blue.
yeah,
That's not how it's going to work.
exactly.
It's going to most likely be the way that the recession is most likely going to come, like we've always been saying, is the soft landing is going to have to expire. Everyone's going to have to be baked into it. Oh, we've achieved it. The Fed's going to actually believe they achieved it. Everyone's going to think, oh, recession, maybe next time, right? And a lot of people saying, oh, we're there right now. No, we're not there right now. You can tell people are still very cynical about the market. They're like, oh, no, something's going to break. Everyone just waiting any day now. Volatility is going to just rip to 50, VIX 30 inbounds, all those types of bullshit, right? Long story short, this whole thing is a game, right? The market's going to build towards a recession, and it's most likely going to be the build where everyone's like, oh no, this is a dip time. This is the dip we should be buying. This is the pullback. This is the healthy bull market pullback. And in NQ, realistically, we have 9% of downside in bullish trend. So there is an aspect of that healthy bull market pullback, because obviously NQ is in a bull market. No matter who wants to, it's been in a bull market since end of March. I don't care who doesn't want to hear it. It's just what the chart says, right? NQ's in bullish trend. We can pull back 9% from here, almost 10%, and still hold bullish trend, bounce, and continue higher. It's this type of move or this type of situation where we're up off the lows and NQ comes down. Everyone, maybe it's not the first flush that everyone's like, oh, we flush and we bounce at some point. Maybe we don't flush, but you get my point, where the market will move lower if there is a real recession in terms of a major economic slowdown. And it might be the bounce that gets everyone there, so on and so forth. It's not going to be just everyone's going to time. Look, if you think everyone who's claiming that there's going to be a recession and is now telling you to short the market here is going to be right, it's a bunch of bullshit. Come on, you think they're gonna get this dead cat bounce? Well, they want to call this a dead cat bounce, but this is a new bull market. You think they're going to time the new bull market down to the T? They're not, because they're not going to get the recession right, most of them, overnight. They're not going to wake up one morning and NASDAQ limit down. Like, it's not like tomorrow, a Monday morning, the NASDAQ is going to be limit down because recession has been confirmed today. That's not how it works. It's a progression, right? We moved into the recession here, and we moved out of, or the market recession in terms of pricing an expected recession. The market realized that wasn't the scenario of highest probability, and we progressed out of it this way. It wasn't boom, boom. That boom, boom, that's COVID. That's this. That was an unexpected tail event. Thought it was going to slow everything down. And we stopped the whole world. The market went down, and basically through the Fed's interventions, QE and whatnot, and government workarounds, we were able to get everything back up and running again in rapid time. The world was shut down for what? It was shut down from March, and theoretically some places didn't open up right away. But you got my point. It wasn't a complete shutdown for such a prolonged period of time where the world went extinct. The market was able to work around that. Rapid recovery.
Yeah,
This is a little bit different.
This recession, it's going to, the market is going to start pricing in higher probabilities of a recession over time, and that's exactly what our system will pick up. Our system monitors every corner of the market, and it starts getting priced in before.
Right.
It's all about just reading the signs, looking at asset performances and reading what the market is telling us.
Right. And the system's goal is to get into those progression, or I should say those shifts, right? Where the progression changes from higher recession probabilities to higher expansion or risk on to risk off probabilities. The system tries to get in as early as possible and ride the wave for as long as possible, where things are of most probable in terms of things are most likely going to happen, right? So the system tries to aim, or the system aims in positioning themselves right at the pivot, holding for as long as possible with the most probabilistic outcome, and then dipping, bailing ship, and going into the next or most probable outcome, I should say. All right. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on our website at market-radar.com or our Twitter at the Market Radar. Our Discord is open with a free public section. You can go in there and you can converse with us on a basic level. You can converse with some of the other members, but we also do offer a private Discord and private daily updated reports via our Radar membership. Go to our website to find out more. Thank you so much.